So I do have Michael Episcope from Origin Investments, and he's going to be talking to you today about their Class A multifamily opportunities that they have in opportunity zones nationwide. Origin Investments has been one of the leaders in the opportunity zone industry since the very start. They quickly received a huge flurry of capital commitments when they first announced their opportunity zone fund way back when. I think that was toward the beginning of last year, or was that a couple years ago now? Michael, how are you doing today?
Good. Thanks, Jimmy. That was at the end of 2018, early 2019 at that time point. And I got to say, I really enjoyed listening to Ashley. I think he laid a great foundation, which is going to make my job that much easier today.
Great. Well, I'll let you take it away then, Michael, if you want to start sharing your screen. And while you do that, just a couple of announcements for everyone in attendance today. Again, if you're just joining us, we do have a Q&A toolbar in your Zoom app. So please feel free to use that if you have any questions for Michael or for any of our other panelists. And the sooner you ask your question, the more likely it is that I'll be able to get to them. We actually, I'm sorry, we did not get to all of the questions that were asked during Ashley's session. We kind of ran out of time, but Michael, are you able to share your screen okay?
Yeah, I am. I'll just give a few minute introduction, sure, and then I'll share my screen if that's okay.
Okay, well, yeah, please take it away then.
So I have roughly, I think, 30 minutes, Jimmy.
Yes.
Hopefully there's a break in between in case we go over.
Yeah,
and I'm going to spend 20 minutes for everybody's benefit, just covering the company overview and our QOZ fund, and then we'll open it up for Q&A. And my goal for this presentation today is to give you enough information about Origin and our QOZ fund so you can determine if it makes sense to take the next steps. And obviously, given the limited time constraint here, I'm not going to be able to go into as much depth as I'd like to, but I will give you a way at the end to contact us and get that information. And so today I'm going to focus on things that are unique to Origin and not necessarily the things that Ashley covered. Again, he did a great job creating the foundation and helping, so I can focus on really the things that are unique to Origin. So let me share my screen now, promote my screen. All right, you can see it, right?
Yep.
So we've been around for nearly 14 years, and the company was started by David and me. David Shearer is my partner. I'm actually the co-CEO and co-founder of Origin Investments. And when we started the company, it was really centered around our own capital. And our goal was to use real estate to grow our wealth and create tax-efficient passive income streams, more like a family office. This is actually our second career. And I think that's an important place to start because alignment matters. And every decision we've made over the last 14 years was and is still centered around what's best for our capital. And it's about where we invest, what asset classes do we invest in, who do we hire, what deals get approved, fund terms, everything. There's hundreds and hundreds of decisions that go into building a firm and creating a fund and making them successful. And I'm proud to say we're still the largest investors at Origin today. We've personally invested more than $50 million of capital alongside investors. And we have $7 million of our own personal capital in this fund as well. And candidly, if I could find more capital gains to invest, I'd invest more. But I'm tapped out, and I've contacted my CPA more than a number of times to ask him about that stuff. So I think what Ashley was saying is absolutely true. If you believe in this program, even if you believe that taxes are going up, this is where you want your money because of the tax benefits, the long-term tax benefits, forgiveness. So as a company, we have 32 team members, and we have 4 offices across the country. We invest in 11 markets, and we're almost exclusively in low tax, moderate to warm climates. Let me jump. Okay, you can see that screen. And this is where the majority of growth is happening in the post-COVID world. And so our model gives us the ability to invest nationally, so we're not pigeonholed to any region. And these markets do change, and they will continue to change over time as we evaluate where population growth is happening and where job growth is happening as well. And especially in a post-COVID world, we've been rejiggering the lines around where we want to invest and having a lot of those conversations. So to date, we've invested more than $2 billion across office, multifamily, retail, and industrial. But today our focus is primarily on multifamily. And the QOZ fund, as it stands today, it's 100% multifamily, but we still have the opportunity to do things, to do industrial. We will not be doing any office in this fund or retail in this fund either. We're a trusted real estate manager for individuals, family offices, advisors, and have roughly 1,200 investment partners today. So let me jump to our track record, and this is the last sort of about Origin slide, and then I'm going to get into our QOZ fund. We've operated 5 funds to date. Funds 1 and 2 were ranked top decile performers, and that is for their vintage, their size, and their risk. And this is done by a third-party company called Preqin. And our fund 3 is tracking towards a top quartile fund right now. So for the mature funds, we are 3 for 3. And for our existing funds right now, QOZ and our Income Plus funds, those aren't mature enough to actually benchmark today, but I have no doubt that we're going to be tracking in that top quartile, top decile based on the assets in those funds and the way they're shaping up today. We've had 0 losses across our portfolio. We've never lost money on a deal. And I believe that the reason why we're consistent is because of all the reasons I mentioned before, because of the alignment, but our investment strategy, the quality of the team, the discipline we exercise in making our decisions, and great execution. And there's a couple of metrics I want to point out on this screen. 60% of our deals are sourced off market, and great execution to us starts with buying right, because that gives us the distinct advantage in the buying process. And our team lives in their markets, and they have local relationships that lead to off-market opportunities in them. And that's just one metric by which we look at about buying right. What's equally as important in any investment management firm, and you're going to be seeing a lot of pitches today, is the ability to maximize value over the hold period. And this is especially true in QOZ, because QOZ is what we call a build to core model, where you're spending 2 to 3 years in the construction period, and then your hold period might be 10, 15, even 20 years. So it's important to understand and know how to manage assets during that hold period as well. And I think this is one of the areas that we excel in greatly. And one of the metrics I want to share with you here is online reviews, because in a virtual world, they matter, and they matter a lot because they really impact every operational metric at a property, including occupancy, retention, foot traffic, et cetera, that all lead to greater value. But we're extremely proactive in this area. And it's as simple as finding the right times to ask for reviews. When you do a service call, if somebody's happy, you ask for a review. And we see so many opportunities out there, especially in the already built world, not necessarily for the QOZ fund, because this is a development fund, but in the already built world where we'll take over property that's a 2-star property, where by inserting new management, you can get those properties up to 3, 4 stars. And I'm spending some time on this because this is an area that we excel in, and it's one of our value adds. And it's so important because of the hold period of QOZ to be able to maximize cash flow and yield and value over the bulk of the hold period. So let me jump into the QOZ fund itself. Now, this is, I believe, why most people are here today, to look at deals and funds. And I'm going to talk about the fund in general, and then I'm going to talk about one of the deals in the fund as well. And I want to be clear that we are actively raising capital and accepting new investments for this fund. And anyone investing in the fund between now and the end of the year will be immediately diversified across the 5 assets you see in front of you. There's actually 6, but one is a pending deal in Orlando, and that doesn't close until June. And you will be buying it at cost. And we are going to be floating our $10 unit price starting on January 1st of next year. But what we've done in this fund, because development takes about 2 years to complete, and then you begin to mark up the values, is that for the first 2 years, we are not marking up the unit price. The unit price is fixed at $10. And then at the end of the fourth quarter, at the beginning of next year in Q1, that unit price will begin to float as we mark assets to market. And this fund will close at the end of next year. So we will be accepting commitments this year and next year. And at the end of next year, the fund will be closed and we will raise a second fund. And when it's all said and done, this fund will have between 7 and 10 assets with a gross property value of right around $600 to $700 million. So I'm going to go into a case study, Elan Pikes Peak, and I'm highlighting this asset for two reasons. First, it's sort of a typical asset, what we look at, and it's our most recent acquisition. And the second reason is because we're about to acquire our second asset in Colorado Springs, and there is an opportunity for individuals to invest directly into that asset, but not until the new year in about January and February when we're done with due diligence. But the economic and business plans of this deal and that new deal in Colorado Springs are nearly identical. But I do want to be clear that anyone investing in the fund will get exposure to both deals. So Elan Pikes Peak, it's a $32 million deal of which the fund has a $17 million exposure. And we syndicated $15 million of this deal to our fund investors and outside investors. And that $15 million was actually fully subscribed in 3 days. So there's a lot of demand for QOZ investments, especially in great markets. And I'll talk about this deal a little bit. This is a 322 unit Class A ground up development. We are joint venturing this with Greystar. And for those of you who may not be familiar with Greystar, I would classify them as the preeminent developer in the United States. They manage around, they own and manage, I should say, around 170,000 units and have more than $36 billion in property, in gross asset value of properties under management. And really the way this came to be is our acquisition officer, Tom Briney, he lives in Denver and he's been looking in the Colorado Springs market for quite a while. He's had a relationship with his Greystar counterpart, and they've been working together for a couple of years. And so we were brought into this opportunity to provide the capital and joint venture with them. And what we liked about this deal, several things. First is location. If you kind of understand what's happening in Denver, Denver has been a growth market for the last 15 years. It's blowing up in terms of population and job growth. But what also happens in a city like Denver is you get the growing pains. You get congestion and traffic, and where you used to be able to get from downtown to the ski areas in an hour and a half, sometimes on the weekends now that can be 3 hours. And so that big city pain and those problems are actually pushing people south to Colorado Springs. You have tremendous job growth down there. You have a lot of population growth. You're right on the Front Range. You have access to skiing, and Colorado Springs is growing faster than any major market in the US right now. And it's the only major market to have had positive rent growth in every month for the last 12 months. And that was through the entire COVID period as well. And our belief is that markets like this, these lifestyle cities where people really want to live, where they would retire, but where they also want to work, these are going to be the long-term winners. And this is where we want to place our investments for the next 10 to 15 years. And so that's really, so it all starts with the location, because these are going to be long-term holds. The other thing about this deal are you have to love the economics. And this has a return on cost above 6.5% on this property. And for those of you who aren't in real estate, that is a very high margin opportunity. We compare that to current cap rates, which are trending below 4.5% right now. So that's about a 30%, 40% margin on a gross value, and that's before leverage is put on. And one of the other things that's unique to this investment is that we are a first mover in this market, and this has a property tax subsidy on it, that the city, we were able to negotiate a TIF, or a tax abatement. And so what that means is that we only pay 25% of the property taxes on this property for the next 20 years. So if our property tax bill were going to be $600,000, we would only be paying $150,000. And that cash flow is a benefit to investors because that creates yield. And certainly that will be around for our entire hold period. So we estimate the value of that, that tax abatement and that city subsidy at about $6.5 million. And we bought the land for about $6.7 million. So those are roughly a wash. So it's like getting the land for free. It's a huge edge to this deal. And lastly, what I'll say, and this is just typical, our loan to cost on a project like this is 65%. Once we build, it'll be below, loan to value will be below 50% on a deal like this. So the multifamily sector is one of the lowest risk sectors that you can get into. It's something that we favor. There's a reason why we're 90% into this today. It is an essential asset class, but you really have to know where the demographics are moving to today in a post-COVID world. Jimmy, how's this slide? Is this okay?
That one looks a little bit jumbled too. You might have to just kind of whatever you did last. Yeah, there you go. Now it's fine.
Now it's fine.
Just do that every time, whatever that was.
Okay. All right. I'll slide it a couple times.
Yep.
So this is our expected value at stabilizations. And these are all of the opportunities currently in the fund, except for the Orlando deal, because we haven't closed that yet. That's going to happen in June or July. And what you see here are the expected values once stabilized, which is really around years 3 or 4. And all these valuations have been re-underwritten in a post-COVID world. And I think what people need to understand, because a lot of people look, well, you're buying in at cost, but some deals were bought pre-COVID. But the reality is that values haven't gone down in most major markets, right? I would say that there's exceptions to the rule. Certainly New York, San Francisco, LA, cities like that. You've had an outpouring of residents, but I think with the vaccine, you're going to see those markets start to come back up. But in most cases, like Noda, for example, we bought that land in 2018, and it was a very large parcel. Certainly, it's a 3-phase development project. And when you're buying something in 2018 and it's almost 2 years later, that land on a very conservative estimate has gone up 30 to 40% over that time period. And one of the reasons is because we were one of the first movers in QOZ, and that's a piece of land that we took down right away. Now, all of these projects are in different stages of completion. Fourth at Navigation and Pilsen are going vertical, and those will be delivered next year. Elan, Noda, and Union, those are going to start going vertical in the first half of 2021. And what you have here is around $92 million of cost versus $153 million of value at completion. And so those are what I'll say is the year kind of 3.5, 4 value. And what that tells you is the value that we're creating through the construction period, but it doesn't include cash flow or future appreciation. And here is the full picture from an investment return standpoint. Jimmy, is that good?
That looks good, Michael. Yeah, that looks good.
Okay. All right. Something's
great
going
work.
on with my slides there. Appreciate that.
Yep.
So the fund's base case is a 2.5x multiple on equity over a 10-year hold period. And certainly the line isn't going to look as smooth as this. We write up our assets at the end of the construction period as leasing begins. So you'll see, kind of a line like that. But what matters is what we're underwriting to at the end of 10 years. And this is on a net basis. This is after all fees are considered. And this does not consider the tax benefits of the investment either. Those happen on your side. So this is just looking at what the fund will generate to you on a net basis, not factoring in any of the tax benefits. And you're going to be seeing several presentations today. And I would just urge you to make sure that you're looking at things on an apples to apples basis, because there's gross return, there's net return, there is the after-tax equivalent return. This is a net return. And I believe this is the right way to present information. So the last thing I'll say about this, we tend to be conservative in our underwriting, and I believe we have more room for upside here. We've missed on the right way, which means that the upside tail is what appears. And we had an opportunity very similar to Elan in Atlanta. It was a newer submarket. We were one of the first movers. We had a government subsidy, and we underwrote it to a 2x equity return and a 16% IRR over a 5-year hold period. And what happened was we ended up generating a 3.5 times multiple on equity and north of a 40% IRR over 3.5 years. So we provide these projections for everybody's benefit, but at the end of the day, our job is to protect the downside and let the upside take care of itself. And we do that by identifying good partners, great markets, using low leverage. and doing everything we can to make sure that the project gets built on time and on budget. So, Jimmy, how are we doing for time here?
You're good on time, Michael. You got another about 10 minutes or so, including Q&A.
Okay.
I've got my next presenter scheduled to start at 11:35 a.m. Eastern time in about 15 minutes.
Okay, so I'll go through a couple of these last slides really quickly so we can open up for Q&A. But this is a slide everybody asks about, is cash flow, and this is really important. I wanted to cover it and because you have a tax liability in 2026 payable in 2027. And so we will be returning from each and every asset at least 25% or more of capital through our refinancing activities. And that's once the project is built and delivered. So it gets revalued and then we right size the loan. We put long-term debt on it as well. And hopefully we can take advantage of some of these low interest rate opportunities that we're seeing today. Capital will also be returned through cash flow. And once the fund is fully stabilized, we expect it to produce right around a 7% annual yield on your original invested equity. So between the refinancing and the cash flow, by 2026, you will have plenty of money to be able to pay your tax liability at that time, even if taxes do go up, right? Which I think we're all hoping that they don't and they stay moderate. Okay, and the last thing I'll talk about, I'll give a quick review of fund terms. We charge an annual asset management fee of 1.25% and a one-time 50 basis point acquisition fee. We don't charge a committed fee on this fund. So when you invest, there's no historical charges that you're being charged on. And a lot of funds do that, especially in the closed-end funds. So you will pay, you will be backdated as you came in on day one. We do receive a 15% performance fee, and that's subject to a 7% preferred return, which means we only get paid after you receive a minimum of a 7% return. And lastly, we charge an administrative fee between 0% and 2%, depending on the size of your investment. The fund will be audited. We use an outside fund administrator for the fund, and all of this stuff can be found in the fund's investment deck as well. And again, we will be accepting capital into this fund through the through this year and the end of next year, and then it will be closed. And lastly, I'll get through this, how to invest with Origin. I can leave this slide up for a few minutes for you to do this, but the easiest way is just email us, investorrelations@origininvestments.com. I know that's a long one, but I think it's also memorable. So I'll leave you with this before we open it up, but I've been investing for 25 years, and I learned a long time ago that it's not just about the returns. I think we do a great job at that. It's about the returns plus great communication and being connected to your investment. And we spend a tremendous amount of time educating our investors, doing webinars, making sure that they get their investment materials in a timely manner, in a way that they can understand them as well. And when you invest with Origin, that's what you can expect, is getting your information in a timely, a regular basis, great communication. That's it today, and I appreciate your time. Jimmy, let's open it up for Q&A.
Thank you. Yeah, thanks, Michael. That was great. We've got about 10 minutes for questions here, which is fantastic. A couple questions. People want to know, what is the investment minimum?
So the investment minimum in the QOZ fund is $50,000.
Okay, and then I got a question here. Let's see. Randy wants to know, why are you in Chicago, not in the Sun Belt and losing population?
Yeah. Well, believe it or not, Chicago is a market that, historically, because we're here, we've actually done very well in Chicago real estate. So when you bifurcate Chicago and you look at the downtown, the near north, the West Loop, you've actually had submarkets that have been some of the fastest growing in the United States. But certainly the fiscal woes after COVID, we've actually removed Chicago from a target market going forward. But when we talk about having local market knowledge, having a presence here, understanding your markets block by block, because we live here and this is where we're headquartered, we've had that advantage. And ironically, we've actually done better in Chicago over the last 10 to 12 years than we have in places like Austin. So there's idiosyncrasies behind deals. And when we find opportunities that have great edge. There's always an exception to the rule, but it's a very astute question. And the answer to that is that going forward, Chicago is no longer on our market. And I talked about that earlier, how we're constantly reevaluating our markets. And I hope that the politicians here can get us back on track without simply raising property taxes.
Great. Next question, it comes from Francis. The question is, how do you pick a developer for a project? You mentioned how important these relationships are with your partners. So how do you pick a developer for a project? Specifically, how do you compensate the developer, and how much does the developer typically invest in a project?
Yeah. So a lot of questions there. I'll see if I can remember them, but keep in mind, we've been doing this for 14 years. So we have long-standing relationships with a lot of developers, and we have never committed to a project and then pulled out. So we have a very good relationship with all of these developers in the market, and we are one of their first calls when they have a development that they believe is something that we would be interested in, right? So it's about these local relationships. And typically a developer, a JV, would look at like 95-5 in terms of we're bringing 95% of the capital to the table. They're bringing 5% of the capital to the table. And then there would be a waterfall that we negotiate. And that's very typical in any joint venture. So a group like Greystar, individuals can't invest with them directly. Greystar only invests with institutional investors. So what we do is we come in there and we negotiate on behalf of our capital the best deal we can. And of course, they're going to get paid market rate development fees. They're going to get paid market rate property management fees. And that's all part of the negotiation. And I think it's one of the advantages when you're not vertically integrated like a firm. We represent capital in those transactions. So we understand what market rate property management fees are. We understand what market rate development fees are, market rate waterfalls are in these structures. And we do our best to pay them fairly, but not overly pay them. And sometimes when you get a vertically integrated developer and they have property management and development and they have a waterfall and capital, there can be conflicts of interest. So I really like our position, and it's been something that we've done on purpose so that we would limit the conflicts of interest throughout the structure. But I will tell you that Greystar brings more than their value, and they're the ones who had this. This was a shovel-ready development, and they were the ones who were able to negotiate the tax abatement with the city. So they've earned their fees and more here. And we're really happy with those, that relationship and that investment.
And then the last part of that question was, how much does the developer typically invest in a project?
5%, 95-5 deals. Yeah.
Okay. Let's get back to a few more open questions here. Randy asks, do you do cost segregation studies and pass along the excess depreciation to investors?
So historically, we haven't. That is something we will look at in this fund. We are still in the ground up development phase, so it's not time to do that because there's no depreciation. But historically, cost segregation, because our old funds were buy, fix, sell, it doesn't really give you an advantage because anything you do above and beyond straight line depreciation, you're actually taxed at ordinary income. So when we looked at the cost segregation, but we will do what's ever in the best interest. But if we can already shield 100% of our cash flow through standard depreciation, then there may not be a reason to do the cost segregation on these properties. So it's something that we're going to evaluate. I'm not going to say no. I'm not going to say yes.
All right, sounds good. We got time for a few more questions here, a few more minutes before I bring on our next presenter. How will you value the QOF investment interests?
So those are unit based, and essentially what it is that it's very simple. It's almost like a stock, but you value the underlying assets and the liabilities and all the other assets of the fund, cash included, and you just divide that by the number of units, and you get a unit price for that particular fund. So again, the fund is audited. We have an outside fund administrator that there's a check and balance here. And so this is something that we already do on our Income Plus fund. We value that on a monthly basis, and it's a process that we've gone through many, many times.
Okay. We still got some good time here. We got a lot of questions coming in. By the way, if we don't get to all of your questions, I'll try to pass them on to Michael, and we'll try to get you some answers offline, just so you know, because we've got, I think, more questions than we're going to have time to answer. But next question coming in is the cash flow 7% over the course of 10 years subject to short-term capital gains tax?
No, the cash flow would be shielded by depreciation, and the cash flow that's not shielded would be ordinary income. So it's not capital gains tax. It would be considered short-term income. But as we model this out from a tax perspective, we have plenty of depreciation to shield 100% of that cash flow. And as I said earlier, if it makes sense to do cost segregation in this to create more depreciation tax benefits, then we will. But this is an incredibly tax efficient fund. And what investors will find, especially early on, are more losses on their K1 from an accounting perspective, which is a good thing for the first several years, that hopefully they can carry forward if we do have some gains.
Excellent. This question's from Jerry. He asks, what is the actual name of this Origin fund, and when did it start raising capital?
So it is the Origin QOZ Fund, and we started raising capital in late 2018, early 2019. So NODA, which is in Charlotte, was a land piece, was our very first deal that we took down, and we ended up negotiating that deal in the middle of 2018, but we actually didn't close that till early 2019. So that's why that 2-year window is expiring, for which we will then end up floating the unit price on the fund.
All right. Give you a couple more questions here, Michael, and then I'll cut you loose. What is the headcount in your organization dedicated to the Opportunity Zone business?
So we have 32 team members at Origin, but we don't have individual, what I would say, arms that are dedicated to the fund. So our acquisition team is in the market. They're looking for opportunities for Income Plus Fund and our QOZ Fund, and there's no overlap. Income Plus are stabilized assets, preferred equity, and in fact, there is a tremendous amount of synergy between funds, especially when you can solve a lot of problems for the market. When you have ground up development capital, and you have preferred equity capital, and you have core plus capital, we have different buckets of capital depending on what the need of that particular development is. Our investment management arm, the same thing. They're not looking at this from QOZ or Income Plus or other deals. They're working on all of the opportunities. We obviously segregate those into different funds, but we don't have team members who are you're on QOZ, you're on QF. We certainly have people who own certain parts of the qualified opportunity zone, such as our in-house counsel owns the compliance of the QOZ fund itself, but he obviously does much more than that as well.
Excellent. Well, thank you, Michael. Thanks for presenting today.
Thank you, Jimmy. I appreciate it. And I certainly appreciate everybody's time today and the questions that came in.
Excellent. Well, thank you, Michael.